For more on this, we're joined by Tim Waterer in Sydney. He's Chief Market Analyst at KCM Trade. Good to speak to you, Tim. Now, with oil effectively dropping 10% this week, how quickly will this relief filter down into broader consumer inflation figures?
Nice to be with you. Yes, I think consumers and central bankers alike will be very happy to see the moves that we've seen in crude markets this week on the premise of a reopening of the Strait of Hormuz. But I think that that relief in prices, that could be a little bit further down the pipeline, I think. And that's because we still haven't seen crude return to pre-war levels just yet. I think traders are wanting to see a bit more evidence about how the reopening of the Strait of Hormuz will look like, and if and when that comes to fruition. So right now, yes, I think the crude price is basically positioning for additional oil to hit the market. But like I say, it could be some time before we see that reflected in lower prices on the supermarket shelves, because I think it's not the work of a moment to basically restart the global shipping lanes out of the Strait of Hormuz. So I think, that's oil market very optimistic at the moment, but I think price relief could be a bit further down the pipeline.
And despite this positive market sentiment generated by the historic diplomatic breakthrough, we're seeing hawkish Federal Reserve projections currently overpowering the market. Why is that?
That's really the big question, I think, still lingering over the market. What will be the inflationary legacy of this war? Now, after effectively the Strait of Hormuz being closed for around about 4 months or so, maybe the end hasn't quite come quick enough for a number of central banks. We saw the European Central Bank raise rates last week, Bank of Japan raise rates this week, and we also heard a very hawkish Federal Reserve, as you mentioned. So even though the central banks will be happy to see crude prices moving lower, like I say, it may not have come quite quick enough to offset the hawkish tilt from a number of central banks, and that's got a lot of the market now really expecting a rate hike by the Fed in Q3 or Q4 this year. And those expectations for tighter monetary conditions, they are normally constrictive for growth, and that's what's just applying the brakes to some of the sentiment around markets at the moment, is that high interest rates could still be on the way, even though it looks like we have an end to the conflict.
And it's been a volatile week for equities. Are these sudden pullbacks in major Asian indices simply temporary profit-taking, or do they signal deeper structural economic concerns?
I think that the pullback we saw today across a number of markets, I think that was mostly linked to profit-takings, particularly with the US market closed overnight. I think investors were just looking to take some profit off the table ahead of perhaps an uncertain weekend. Let's see how the rhetoric goes between the US and Iran, because it's not exactly an ironclad agreement we have in place right now. So I think a little bit of scepticism, traders leaving a bit of room for maybe some disappointment should things flare up a little bit again. So, but I think just generally speaking, the AI trade is still alive and kicking, given the momentum we've seen on the back of the SpaceX IPO last week. So yeah, mainly profit taking. I don't see too many structural issues today, particularly as the market does like the side of crude oil moving down around 10%, as you mentioned.
And of course, there is a positive sentiment across markets, but how long will it realistically take for global shipping supply chains to completely normalise following the largest disruption on record, as we mentioned?
Yes, that's a bit of an unknown at the moment, but I think we're talking months rather than weeks. I think traders will be looking to see, okay, how long does it take to normalise? They'll be keeping a very close eye on traffic numbers through the strait. It may start as a trickle at first, but in terms of returning back to 100 plus tanker movements a day, yes, I think that could be a couple of months in the works. So that could test the patience of the market if it doesn't come to fruition as soon as is currently expected. So yeah, in terms of when, I guess that relates to when could we see pre-war crude prices return, and by that I mean Brent crude trading at $70 and below. That could be more like a later on Q3 or Q4 proposition for markets, given there's still a few things to be worked out, I think, in terms of getting things up and running and normalising in the Strait at the moment. Still a few barriers there, I think.
Tim Waterer in Sydney, thank you very much as always.